The housing market just flipped in a way that caught almost everyone off guard. For the last couple of years, we've been told the same story: low inventory, high demand, and prices that felt like they could only go up. Investment. Buyers were locked in bidding wars, sellers had the upper hand, and the idea of a slowdown seemed impossible. But suddenly, almost overnight, everything has changed. Inventory is piling up, affordability has collapsed, and what once felt like an unstoppable market is now showing cracks nobody saw coming. So, what actually happened? Why did this shift take place so fast? And most importantly, what does it mean for buyers, sellers, and investors moving forward? Today, we're breaking down the unexpected twists shaking the housing market, the hidden factors driving it, investment, and how you can position yourself in a moment where panic and opportunity exist side by side. Do you want me to directly continue into Keynote 1, say, expanded into 400, 500 words after this intro? The sudden shift in buyer demand has been one of the most surprising turns in the housing market. Not long ago, homes were selling in a matter of days, often above asking price, with multiple offers competing for the same property. Buyers were rushing in, driven by historically low interest rates, the fear of missing out, and the belief that prices would only climb higher. But what once felt like unstoppable momentum has hit a wall, and the slowdown has been sharper and faster than anyone predicted. At the core of this shift is affordability, or rather the lack of it. Mortgage rates have climbed compared to the rock bottom levels we saw during the pandemic. And when you combine higher borrowing costs with record high home prices, monthly payments have become out of reach for millions of would-be buyers. The math simply doesn't work anymore for the average family investment, and that reality has forced many to step back and wait. What makes this moment unique is how quickly sentiment has changed. Just months ago, open houses were packed and sellers had all the leverage. Now, showings are quiet, homes sit longer on the market, and buyers who are still in the game suddenly have more negotiating power. This isn't just about numbers, it's about psychology. Investment. When people feel uncertain about the economy, their jobs, or whether home values will keep rising, they hesitate. And once hesitation enters the picture, demand doesn't just slow, it can dry up almost overnight. Another overlooked factor is that many potential buyers are already stretched thin. Credit card debt is at record levels, student loans are restarting, and everyday costs like groceries, rent, and gas have surged. Investment. Even if someone technically qualifies for a mortgage, they may not feel confident taking on that kind of long-term commitment right now. That uncertainty has created a ripple effect where fewer people are willing to jump into the market, even if they've been planning for years. This shift in demand is not necessarily a crash, but it is a reset. It's forcing sellers to face reality and making buyers reconsider their timing. What seemed like endless upward momentum has been replaced by caution, and that sudden reversal is exactly why so many people are asking, what just happened? The rise in inventory has been one of the most shocking developments in the housing market because for years, the narrative was the complete opposite. There simply weren't enough homes to meet demand. That shortage pushed prices to record highs and fueled bidding wars that made buying a home feel nearly impossible. But now, the pendulum is swinging the other way. Across the country, more and more homes are hitting the market, yet buyers are not rushing in to scoop them up. This creates a strange paradox. On one hand, inventory is climbing, investment, which should be good news for affordability. On the other hand, higher mortgage rates and stretched household budgets mean people can't actually afford these homes, even though there are more of them available. Part of this surge in listings comes from homeowners who are realizing they may have missed the peak. Last year, sellers could list a property almost blindly and still expect multiple offers. Now, as signs of cooling spread, many are rushing to put their homes on the market before prices adjust further. This flood of new supply creates the impression that the market is softening much faster than expected. Investment, catching both buyers and analysts off guard. What's unusual is that rising inventory doesn't automatically translate into affordability, because the real bottleneck isn't the number of homes, it's the cost of financing them. At the same time, many of the homes entering the market are not necessarily in the affordable range. And sellers with higher end properties are testing the waters while starter homes remain limited. This means the inventory growth is uneven, and first-time buyers who already face the toughest affordability squeeze aren't necessarily benefiting from the shift. For them, the dream of homeownership feels even more out of reach, despite the headlines about more choices. The broader effect of this imbalance is confusion. Sellers are asking why their homes aren't moving like they used to. Buyers are wondering whether to wait for further price drops. And investors are questioning whether this is a short-term adjustment or the beginning of a longer trend. The housing market thrives on confidence, and when both sides of the transaction feel uncertain, activity slows down. Rising inventory in this case isn't a sign of relief. It's a symptom of deeper issues in affordability and demand. That's why this moment feels so unexpected. The numbers show more homes for sale, but the reality on the ground tells a very different story. The hidden forces behind the sudden slowdown in the housing market go far beyond just rising mortgage rates or inventory levels. While those are the most visible factors, there are deeper, less obvious dynamics at play that have completely reshaped buyer behavior and market psychology. One of the biggest forces is consumer debt. And over the past few years, many households have accumulated significant debt. Credit cards, student loans, auto loans, all while housing prices were climbing. Even if someone has a stable income, investment, adding a mortgage on top of existing debt can feel overwhelming. The result is a market where a lot of people who want to buy a home simply cannot qualify for the kind of mortgage they need, or they feel that taking one on would be financially reckless. Another subtle factor is lending standards. During the peak of the market, banks were willing to extend credit to buyers who might have struggled to qualify just a few years ago. Now, lenders have tightened requirements, making it harder to secure a mortgage without strong credit, a healthy down payment, and a solid debt to income ratio. These restrictions, while protective for both banks and borrowers, have quietly removed a chunk of potential buyers from the market, further slowing demand. Economic uncertainty also plays a major role. Even when interest rates are reasonable and homes are technically affordable, people are hesitant to make big financial commitments if they fear job instability, inflation, or a broader economic slowdown. This psychological factor is often overlooked in housing analysis, but it's powerful. Buying a home is not just a financial decision, it's an emotional one. Makes a good investment, and when the mood of the market shifts from confidence to caution, it can happen almost overnight. Finally, the market is dealing with a mismatch between what buyers want and what sellers are offering. Many new listings are at price points that still feel high given current rates, and buyers are more selective than ever. They are looking for homes that not only fit their budgets, but also offer long-term value in a potentially volatile market. Sellers who don't adjust expectations may find their properties sitting longer, which adds to the perception that the market is slowing down or even crashing. All of these hidden forces, consumer debt, tighter lending, economic uncertainty, and a mismatch between buyer expectations and listings, combine to create a market that feels unpredictable and unstable. The slowdown isn't random. It's the result of multiple interconnected pressures converging at once. And that's why so many people are scratching their heads, asking what just happened to the housing market. It's not a single factor. It's a perfect storm of hidden forces quietly reshaping the landscape. ChatGPT said, "This moment in the housing market is both a warning and an opportunity, depending on how you approach it." For buyers, the sudden slowdown and rising inventory can actually be a chance to enter the market with more leverage than they've had in years. Homes are sitting longer, and sellers who were once in complete control now have to negotiate, making it possible for buyers to get better deals or favorable terms. Patience and preparation are key. Understanding your budget, getting pre-approved for a mortgage, and knowing what type of property you want can turn uncertainty into a competitive advantage. Those who act thoughtfully now may find themselves in a position to secure a home at a price that would have been impossible just a year ago. For investors, the landscape is shifting in ways that require careful strategy. The market is no longer about guaranteed rapid appreciation. Instead, it demands a more analytical approach. Investors need to evaluate not only price trends, but also rental demand, local economic factors, and long-term potential. Properties that are overpriced today might see slower growth or even temporary declines, while overlooked homes in the right locations can become hidden gems. This is a time to think long-term investment rather than chasing short-term gains, and to focus on deals that make sense even if the market remains volatile for several months. Sellers, too, need to recalibrate. The days of listing a home and receiving multiple offers above asking price are largely gone, at least for now. Pricing realistically, improving curb appeal, and being open to negotiations are no longer optional. They're essential. Trying to cling to the peak market mindset can backfire, leaving properties sitting unsold and buyers walking away. Investment flexibility and an understanding of current market conditions are critical for anyone looking to sell successfully in this new environment. Ultimately, investment. What this shift tells us is that the housing market is cyclical and highly sensitive to both economic forces and buyer psychology. Rapid changes can create fear, but they also create opportunity. The key takeaway is that those who stay informed, understand the underlying dynamics, and approach the market strategically will be the ones who benefit the most. In a market where uncertainty is high, investment, preparation, and knowledge become your greatest assets. The chaos we're seeing isn't just a headline. It's a chance to act smarter than the masses, whether you're buying, selling, or investing.